To understand inflation, we got to understand the difference between nominal and real, price and value. Inflation is this insidious hidden tax. It destroys our purchasing power, but it also destroys the value of savings, and that's bad. Stocks, bonds, even equity and real estate. Inflation robs us of the profits from those things, but thankfully it destroys the value of debt. And it redistributes wealth more powerfully than anything else because it redistributes that wealth from lenders to borrowers.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show. He is my good buddy out in Florida. He is a real estate expert, someone I have a tremendous amount of respect for, and I am super excited to have him back on the show today and give us an update on the real estate market. So Jason Hartman, welcome back to the Rebel Capitalist Show, buddy.
Hey, George, it's great to talk to you again.
Give us an update, man. What's going on in the real estate market? What's going on in mortgage rates? I'm assuming it's still booming in the residential areas and the starter homes.
It is. I've been doing this since I was 19 years old, and I don't know if I've ever seen it this busy. I've been through many cycles, and it is crazy, George. I mean, who would have thunk it, right? As the saying goes, months ago during maybe March, right? Who would have thought this would have turned out this way? But the real estate market is just absolutely booming. I just interviewed a guy from Stansberry Research a few minutes ago for my podcast, and he was talking about all kinds of, empirical data, but he shared an anecdotal story, which I think is interesting. He has a friend who owns an excavation company. In other words, they're the ones that move the dirt around for developers. And his excavator friend, who's been doing excavating for 20 years, has purchased a whole bunch more equipment. He started his company with like one backhoe, and now he does jobs for big real estate developers. And he says he has never seen the type of land purchasing and land development at the fever pitch that he sees it now. And he just thinks that the housing market, almost regardless of anything else in the economy, and he's an analyst, he spent 23 years on Wall Street, he works for Stansberry. He just thinks this market has another good 2-3 years of boom times ahead. I'm going to share with you some data today that I think really supports that idea, but your viewers and listeners can decide for themselves. And, you always look at things with a good, healthy amount of skepticism and a critical eye, which is important, and that's why your audience loves you. So feel free to do that today as I'm kind of going through this. And my thesis, George, is that housing, amazingly, housing is actually cheaper today than it was back when my mother purchased her first home in, wait for it, 1976, 5 years after we went off the gold standard. It's also cheaper than it was in the fabled year that George Orwell named a book after, 1984. And it's also cheaper than it was right before the Great Recession in 2006. But the question everybody keeps asking is, are we in a bubble? Are we in a bubble? That is the question I get asked all the time. It's certainly one of the questions you talk about a lot. And, there's a lot of reason to think that we are. And I love the way you look at content because you always look at a long historical history. And so this is a housing price chart, housing price index of the last 112 years. It's not a short view. It's 112 years since 1900 up to 2012. And of course, you've got the Great Recession in there. You see a huge run-up post-gold standard 1971. A lot of inflation in the system as we went off the gold standard.
That's nominal, though.
Nominal. Fair enough. Yes, good point. Not inflation adjusted. And then, we see it go down, right? And if you look at a chart like this, you've got the Case-Shiller index compared to the consumer price index. We all know those are both maligned. Case-Shiller maligned in the sense that it profiles 20 markets for their main index. 75% of those are cyclical markets we would not recommend for investment. And the consumer price index, much maligned also, but it is what it is. We've got the official statistics, which are understated. We both know that, and your audience knows that too. So you can see the divergence here between housing prices and the CPI. And it would lead a lot of people to say, we're in a bubble. This is way out of sync. It can't continue, right? Even you look at the Case-Shiller index compared to the S&P, okay? And that's out of sync, right? If the S&P is a proxy for the broader economy, then housing prices are out of touch with the S&P. Fair enough. I agree. The problem is people so many times are looking at the wrong thing. They're looking at the wrong thing. Remember, nobody buys a house based on a price. They buy it based on a payment. So I'll just share with you a couple of things here in terms of our rich Uncle Jerome Powell. I
Uncle Rico.
Philosophically, I disagree with almost everything he does, but he is my rich uncle. He's your rich uncle. And if he'll give us free money, I'll take it. Okay. So that's the thing. And, as I've shared before on your show, to understand inflation, we got to understand the difference between nominal and real, price and value. Inflation is this insidious hidden tax. It destroys our purchasing power, but it also destroys the value of savings, and that's bad. Stocks, bonds, even equity and real estate. Inflation robs us of the profits from those things, but thankfully it destroys the value of debt. And it redistributes wealth more powerfully than anything else because it redistributes that wealth from lenders to borrowers and from old people to young people. Why? Because old people have assets, they have savings, hopefully, and young people have debts. And so inflation destroys that debt. So here we go. 1976, the median house price, $44,200 in 1976, and the interest rate, 9.01%. Here's how that deal looked. Your house payment for that median price house would be $354 per month. Now let's fast forward to 1984. The famous book that everybody better read because sadly it's coming true. George Orwell wrote 1984, I believe, back in 1948. And sadly, this is all prophecy, right? It's becoming way too true. And, the language is maligned and words have double meanings and we're being surveilled everywhere. And it's, another discussion for another day.
Yeah.
$81,000 is the median house price. Interest rate very high, coming off of the Jimmy Carter stagflation era and Paul Volcker beginning to break the back of inflation, 14.68%. Your house payment is now $1,003. Okay? But let's look at the difference. With some inflation in there, you actually got that house for $356 a month less. Okay, less. Now, I know what you're going to say, and you said it today, and it's very true. I'm not adjusting earnings in here. Earnings are not adjusted in here. Okay? This is just interest rate, house price, and inflation by the official stat. We did not put earnings into this, and earnings, just like the mortgage payment, are also diminished by inflation. Earnings are attacked by inflation. Wages, right? But look at 2006, because now interest rates are a lot lower. House price is a lot higher, $235,000, and the mortgage interest rate much lower, 6.78%. The payment is now $1,532, but adjusted for house price, interest rate, and inflation, official inflation rate, your house actually got $414 a month cheaper. People buy a house on a payment, not a price.
So you're just talking about the payment in real terms went down.
Right. The payment in real terms. Again, not adjusting wages. Okay, so, that's one thing to keep in mind. And the wage growth has obviously been uneven, right? From 1977 to 2018, Americans mostly didn't have a real dollar pay raise. largely because of outsourcing, because of understating inflation and, shipping jobs overseas and so forth, right? But it's pretty interesting. So thoughts and questions, and I'll unshare this and then we'll get to the kind of the conclusion of this, if you will. But you probably have some stuff you want to chime in with.
Well, I think it depends on what question you're trying to answer. I think, and how you define cheap. So if you're defining cheap by a mortgage payment, then it makes a lot of sense. And as a real estate investor, I think to a certain degree you should, because you're buying cash flow, and your mortgage payment is going to be a component as to how much positive cash flow or negative cash flow you actually have. So but I think the way most people look at quote unquote cheap would be the value, or the price, I should say, not the value, but the price of the actual asset. And when you look at the price of the actual asset itself, then I think we're definitely in a bubble. I don't think that there's any way that we could argue that the actual price of the asset is cheap. The way I've been thinking about this, Jason, and I actually had this conversation with Kiyosaki the other day, and I think we've kind of gone into a time where the property, which used to be the asset, or well, let's go back. Back in time, the property was the asset and the debt was the liability. And I think now we've moved into this weird, bizarre world where the property is actually the liability.
Yeah.
Because that's the
mortgage is the asset.
Price.
Yeah.
And the debt is the actual asset.
Yeah. George,
and it's bizarre.
It is bizarre, and it's due to the perverse financialization of the economy. And I've been saying that same thing for 15 years. Most people think the mortgage is the liability and the property is the asset. I look at it the other way around. The property is the liability and the mortgage is the asset. If I could just get a bunch of mortgages that would somehow produce income, like rent, right, and not have a property involved, I would do that all day long. I will say, though, the property, even though it requires maintenance and management, it is also an asset, of course, and I know this is kind of a snarky statement, right? I get it. But, those packaged commodities, the ingredients that build a house, the concrete, the copper wire, the lumber, which the cost of lumber has obviously skyrocketed, and so many of the other commodities, the petroleum products, those are cheaper now, but overall the trend is up, right? And the concrete and the labor, all of that stuff, those commodities are not indexed to any one currency. They're universally needed. They're globally traded. They're not tied to any one currency. They have their own intrinsic value, just like gold and silver. They have intrinsic value. They actually are money rather than currency, I would argue.
Yeah, I think so too. And I think, to sum up the way I see what your slide deck, which is really interesting, is if you're buying for cash flow, I think there's an argument that the cash flow itself, along with the debt, could be cheap. If you're buying just the asset, though, because then you're buying it to sell it, right? And if you're buying it to sell it, then the mortgage payment itself isn't going to matter. It's going to be the nominal value or the real value of the house. So it kind of all depends on what your angle is and what your objective is. It's all like everything else. The devil's in the details.
Right. Yes, you're very right about that. And if you're buying, I would add to what you said, if you're buying to sell it quickly, you could be playing the dangerous game called the greater fool theory, which basically says no matter what I pay, some greater fool will come along and pay more. And we believe people should buy and hold these rentals, because then you get the benefit of the inflation-induced debt destruction we've talked about before. Here's another thing that's interesting, George. One of our team members who's been working with us for maybe 6-7 years now, I actually put him on the podcast years ago because he made me realize something interesting. He lives in San Francisco, and he and his wife have a rent-controlled Victorian.
Oh, yeah. I think I've heard him on your podcast.
Yeah. Patrick is his name. And his wife's name is Robin. And so they rented this place in 1996, I think, or maybe 97, but, in the late 90s. They're paying, I think, $2,400 a month. Now, that property has appreciated in value like crazy over the years. And it's probably worth like, I don't know, I think I asked him, he said it was worth like $2 million now.
Oh, my gosh.
And they're still paying $2,400.
1% RV ratio.
Yeah, it's terrible for the owner. But here's the interesting thing that, government intervention always perverts the market. It distorts the market, and it's a terrible thing. But this is interesting because these insanely low artificial interest rates we have now are distorting the market, but they're going to distort it even worse in the future. And here's what I mean by that. All of the millions of people that have refinanced their homes and are continuing to refinance their homes or have purchased a new home and they've got this 30-year mortgage at like 2.4% or 2.75%. It's insane. I mean, these rates are ridiculous. They're basically getting, George, the equivalent of a super cheap rent-controlled apartment. And this is one of the things that I think makes the housing market rather stable, because these tens of millions of people, they're just going to sit there and enjoy these ultra low payments. During the Great Recession 12 years ago.
Just so I'm following your line of thinking here. So it could prevent them from potentially selling in the future if interest rates go up, because then they'd have to sell and they have to get a new mortgage at a higher interest rate. Their purchasing power would go down. They'd be able to buy less house with the same income. So why sell? Is that your point?
Right. It's why sell, but it also gives them the ability to weather economic storms. Okay. And we all know there's a storm coming if it's not here already. Okay. I mean, you were one of the leaders, first thought leaders back a year ago, last fall, a little more than a year ago, to really profile and expose what was going on in the repo market as it was collapsing. And I mean, hats off to you for doing that, because just nobody else was talking about it, pretty much except George Gammon. Then it's just interesting, as I put on my tinfoil hat, we had the repo market collapsing. They tried to hide that problem, which was a real symptom of a much bigger problem, right? Yeah. And it portended economic collapse. And then we rolled right into COVID. And they had cover for massive money printing, stimulus, bailouts, et cetera, and all the, tyrannical stuff the government has done since then. But what they've given people that have purchased or refinanced a house is a giant gift of really a lot of staying power, that they can weather a storm because they've got like a bulletproof vest. Okay.
Yeah, but let's think that through.
Yeah.
And so I'm sure I've got some viewers right now that are saying, okay, well, it sounds like what Jason is saying is that the government accidentally distorted the market in a good way. And we're just looking at one. Yeah, it's right. There you go. Good for some. Let's think about the knock-on effects, because this keeps prices artificially high, which reduces the ability for people who are in lower income, or the millennials are getting out of college, the kids. Yeah. It reduces their ability to buy a home, which I would argue increases social unrest.
I agree. You are right.
So there's no free lunch. You distort the market, you benefit one group, and it's going to be at the cost of someone else.
I don't want to forget to say something, by the way. As we were talking about migration trends a few minutes ago, what I think we're going to do is we're going to see this in phases. So just forgive me for jumping around. I just don't want to forget this because it's important.
Yeah, no.
Okay. People are leaving the urban areas, right? And rightfully so. They just don't offer much. They're overpriced. And so I think what we've witnessed now is phase one. And phase one is simply, take New York City as a great example. It's simply people leaving Manhattan or, somewhere in the city, right? And they're moving to other expensive areas. certainly the Hamptons, right? Expensive New Jersey areas, Connecticut. All these areas have picked up a lot of new movers from the city. Now, these are people, interestingly, that have tons of money to spend. And when they go to these other areas, although still very expensive areas, most of them, their money spends better than it did in Manhattan. Okay, even though the Hamptons is still massively overpriced and too expensive. Okay, so is Connecticut. A lot of these Greenwich, right, or some of the New Jersey areas. But a lot of them move to Florida, where their money spends incredibly well, and they have this wealth effect where they feel like super rich coming into a market like Florida, right? Or maybe Charlotte, North Carolina, halfback city. A lot of people from New York go to Charlotte as well. And so I think what we're seeing now is the phase one of people just moving to the outskirts. In the Bay Area of Northern California, they might be leaving San Francisco, but they're going to Silicon Valley, still very expensive in Palo Alto, for example, or Los Gatos, right? It's cheaper than San Francisco because you get a single-family home and you get some land and so forth, but it's still very expensive. But what I think is going to happen, and this is a prediction I've made, is that we're going to see phase two and even phase three and maybe phase four of this migration trend. Okay, now we've seen a little bit of it now. Nothing's all or nothing. It's just a generalization. But the next phase will be these people sitting in their expensive place in Greenwich, Connecticut, or the Hamptons, or San Jose, or Palo Alto, or whatever, right? Then the next step is they're going to say, hey, we moved here, honey, right? They're having this conversation, the spouses, honey, we moved here and, we got more house and all I'm doing is having meetings on Zoom. Why don't we just move to Dallas and have no state income taxes? Or Austin or something like that. That's going to be the phase two move. So I think we're going to see a tremendous wealth effect where people with this massive amount of spending power, because they've come from these high equity, expensive markets, and they're trading their equity. And what they're going to do is some of that extra money that they didn't need to spend on a house, where they liquidated their $2 or $3 million house and they bought a $600,000 or $800,000 house in a much less expensive city, they're going to look around and say, well, what else do I do now? Do I start a business with my extra money? Do I put it in the stock market? Do I buy crypto or gold or buy more real estate and buy more investment properties, right? Or, maybe a second home. So it's going to be interesting to see those knock-on effects that happen there. Let's just share the screen here again, and I think you'll like it. Remember, we left off at 2006 in our analysis, okay? So here we have today. We're fast-forwarding 14 years from the last chart, okay? And I'll just, for memory, because we paused this a while, okay? We looked at 1984, 2006. Okay, now let's look at today, okay? And this is, by the way, from last quarter, okay? So it's not completely current. But the median price, $313,000. Everybody's thinking housing's really expensive. It's more than it was in 2006. Okay, there's a bubble.
Housing payments.
Are you sure?
I'm going to correct you. So, housing payments.
But look at the interest rate as of July 30th, 2.99%. That is so artificially low. It's absolutely insane. You and I both know, George, your shrewd audience knows that we are quite literally in an era of negative mortgage rates where even if you never rent out the property, with real inflation and real tax benefits because the interest is deductible on the mortgage, you are getting paid to borrow the money on a vacant house. Okay, but you're never going to keep a vacant house. You're going to rent it. Okay, so it's much better. But regardless of that, here's how it looks now. That mortgage payment is now only $1,319, rounded off. And in the last 14 years, your house payment has gone down by $657 real dollars. The only thing not in this analysis is wages. This is a comparison of housing price, interest rates, and inflation. Okay, right. The house got cheaper. Okay, the house got cheaper. Now, I thought we'd go way back to 1976. That's the year my mom bought her first house. And it's a bicentennial year. It's 5 years after we went off the gold standard. The 70s were typified as a very tough decade. Stagflation, Jimmy Carter, the misery index, blah, blah, blah. We've heard it all, right? So from 1976 to 2020, the house got $299 cheaper per month.
The house payment.
The payment, yes. Principal and interest only, does not include taxes and insurance, okay? So is there a bubble? If so, when will it pop? Remember, it's much more complicated than this. This is simply the housing payment discussion. There are more things to it. There's everything George teaches you on his channel. You know, there's the repo market. There's the Great Reset. There's everything under the sun, okay? And, you know, I'll leave that to your other great videos, George, but at least that's an analysis of real dollar housing payments, and I hope it's helpful.
Yeah, I think that was very insightful. It gives us a different angle on kind of a Rubik's Cube that we're all trying to figure out right now.
Yeah.
And real estate is applicable to everybody.
Sure
whether you're a renter, a buyer, seller, owner, it doesn't matter. So, yeah, I appreciate it, man.